Hi, I'm Dana Samuelson, President of American Gold Exchange in Austin, Texas, and this is our presentation, Understanding the Gold Market in October of 2020. I'm going to try to share my screen here. And there we go. So that is our information, our 800 number, our general email address, and our web address. Here's a picture of our website. And let's get into the presentation. Understanding the gold market in October of 2020. Gold has been driven higher by three separate factors over the last 18 months. Falling interest rates that have created negative real yields, rising debt and deficits, and a declining dollar. Let's drill down on these. This is a chart of the 10-year Treasury yield, the 10-year British bond, 10-year German Bund, and 10-year Japanese bond over the last 3 years. You can see that all of these yields peaked in in the summer of 2018, and then started to go negative. That says the global economy expanded and then started to roll over and started to contract. Over the 12-month period between the summer of 2018 and the summer of 2019, the yield on the 10-year Treasury fell, 1.75 points from 3.2 to 1.5%. When it got to 1.5% and approached negative real yield with inflation at over 1.5%, that's when gold started to react. And that's what drove the gold price higher first, was falling interest rates. And as you can see, since then, rates have fallen even further on the 10-year Treasury from 1.5% all the way down to about 55 basis points. And they've stabilized between about 75 and 55 basis points now. But this is a negative real yield now when you factor in inflation of about minus 1%. And this shows that. Here's the real 10-year yield when you factor in inflation. Now, this is what helped to drive gold to a record high in 2011 here. And now we've seen it come into play again in 2019 and especially in 2020. So when the yield that you get on a 10-year Treasury is less than 1% and the inflation rate is close to 2%, you're going to have a negative real yield. And as Rick Rule likes to say, when you invest in a 10-year Treasury, you have no return and risk. What good is that? That's why gold is looked at favorably when there are no carrying costs associated with it. When there are carrying costs associated with it, when you get a negative yield on 10-year Treasury, gold looks much more attractive. And of course, here's the federal funds rate. You're all aware of this. The Fed dropped to 0 for 7 years. Then they raised it up to 2.5 percentage points before less than a year later, they were forced to reduce again. This is in response to the contracting global economy before COVID. And then this is when COVID hit. And we'll probably have a 0 interest rate out of the Fed for another 2 years, maybe longer. We'll see. This is an environment that's good for gold. This is where the real rubber meets the road. This is the month-to-month change in the total non-farm employment report that the government puts out every month. You can see that going into 2020, we were creating about 250,000 jobs a month on average. When COVID closures hit, we lost over 20 million jobs in October. Since then, we've had a surge of job recovery, but as you can see, the amount of jobs we've been creating on a monthly basis is declining. Now that the easy part of the recovery is over and the grind part of the recovery that we are in is occurring, we're still negative net over 9 million jobs, according to these statistics. And jobs are what create a better economy or a weaker economy. So we're operating at about 80% of capacity right now, as far as we can tell economically, and getting the next 10 or 20% back to 100%, like we enjoyed in January and February, is going to be a real tough slog. That's why we think we're in for more debt and deficits, low interest rates, and perhaps a declining dollar as well. So let's talk about that. The basic underlying premise, though, is that jobs are the most fundamental factor to watch, and job creation has been waning of late. And we don't expect it to really ramp up hard until we have a safe and effective vaccine, which may not be till next year. So here's the total public debt that the US has since 2008. You can see that it was rising steadily, and then it has shot up. So our debt has started to really increase rapidly. We've gone from deficits of less than $1 trillion a year to a $3 trillion deficit in 2020, the largest one-year deficit ever. Our total debt's gone from 24 trillion to 27 trillion. And this is not going to change anywhere soon because tax receipts and expenditures are just not going to come together. They're going to probably widen even further. So we expect this trend to continue and the rate of trend not to really moderate that much over the next year or two. This is good for gold. Here is federal debt held by foreign investors. As you can see, this peaked in 2010, 11, 12, 13, 14, 15. And then as the global economy began to regain traction, this started to slough off as foreigners who had put their money in the United States as safe haven after the 2008 financial crisis started to take it back out and put it back into their own countries. Now, this has accelerated recently in 2020 as the US economy has faltered and fallen victim to the COVID closures. And we're actually doing worse than some of our Europe and Asian competitors. And that's why this money is leaving now. This is not good for the dollar because for foreigners to buy into our markets, they have to buy dollars first. If they're getting out of our markets, they're getting out of dollars. And this will weaken the dollar. And here's the dollar index chart over the last 18 months. As you can see, the dollar was stable, trading between 95 and 99.5 on the index chart. No fluctuations normally. And then the coronavirus came. We had a big sell-off, like we had everything sold off in March, and then a big spike as money from all over the world flew into the US, spiked the dollar way up. We settled into a higher trading range, and now as our economy has been undermined by this virus, we've seen the dollar fall as foreigners have pulled their money out of our markets. And then we saw a big fall from July through into September where the dollar really tumbled. This move in the dollar from 97.5 to a little over 92 is what turbocharged gold in July and August from 1800 to 2070 or 2069. So you have declining interest rates, negative real yields, debts and deficits, and a falling dollar have all come together like this in the last couple of months to really propel gold to a new 21st century high in dollars. But gold was already setting record highs in every other major currency as of 2019 and into the beginning of this year. It was only because the dollar was stronger relative that we resisted that in dollars. And now we've seen a new 21st century high in gold in dollars because the dollar has taken a tumble. But we don't think that this is the end of it. You know, under 95 on the dollar index, there's really a kind of a no man's land down to 88.50, where the dollar was hard pressed to get over following the 2008 financial crisis for a couple of years. So there's a lot of room for the dollar to fall if it weakens further. And this will help to propel gold higher. And here is the 18-month gold chart. So when we talked about interest rates turning, this is when we send out our AGE email alert, turning point. And I saw the negative interest rates coming, lower interest rates coming and possibly unlocking the gold price to move much higher. And that's exactly what happened. So we ran up at the end of last year from the 1375 hard ceiling we hadn't gotten over for 6 years to 1560. We corrected back down. Then we base built again. And then the coronavirus hit, we had a big sell-off, and this is when our debt started to really take off. So this is when the debt and deficit started to play into the equation, and then the dollar tumbled. This is when gold really took off. So we've been in a corrective phase in gold since then. Gold has primarily been in a 1900 to 1950 trading range, with a foray down to as low as 1865 before bargain hunters came in and bid it back up. I really think gold is really in about an 1875 to 1950 trading range now, with the bias towards the upside. We don't see the trends that are in place changing anytime soon. Our debt will continue to move higher. If inflation starts to kick in, that will create even greater negative real yields versus what the treasuries are bringing. And if there's a flight to safety and bonds are bid, the yields will be pushed down even further below 70 basis points right now. And of course, the dollar could weaken further. So there's a lot of reasons why gold should and probably will go higher in the future, especially in the next year or two, until we get a real handle on this virus. And then we'll have to see what kind of fundamental underlying economic damage has really got to be fixed. It could take years. So we like gold. We think it's going to 22 to 2,500 in the next 6 to 12 months. Here's a 1-year silver chart. The reason we only go back 1 year on silver is because it didn't really move that much until it played catch up with a vengeance in July, when silver went from $18.50 to $29.26, a 58% gain in 1 month. We've said before, silver oscillates at a wider range than gold, which is more narrow. When it moves, it makes big moves, and that's exactly what happened. So we saw silver run all the way up into the $26 to $28 trading range, hold there for about 2 months, and then it took some profit taking. It took a hit when the dollar moved up a little bit in September. That was impetus for silver to correct lower down to 23. Right now, we're in about a 24.50 to 25.50 trading range, and the market's trying to rebound. This is a classic example of what precious metals do when they're hot or red hot. They take 2 steps forward and 1 step back. And we've got that 1 step back in silver right now. And it's a fairly big one. It's a great buying opportunity. At this price gold, silver ought to be $35 an ounce instead of $25 an ounce. And if gold does what we think it will do and get into the $2,200 to $2,500 range, that means silver really ought to be $40 to $45 an ounce. So silver has a lot of upside potential from here. We really like it. We still like gold, but we like silver a little bit more for these reasons. So this is the federal total debt chart we showed you before. The blue arrow indicates where we think this is going to go. Higher still, probably by another $3 or $4 trillion over the next 12 to 18 months. Over $30 trillion. It's unimaginable a few years ago. We think the dollar will continue to go down. This will help to drive gold higher. And of course, we've got the green arrow on this chart showing where we think gold is going to go. So these are the big trends. They're in place. They're not going to change anytime soon. And the #1 trader's adage is the trend is your friend. Don't buck the trend. In precious metals, it's for higher, and we think we've still got a lot of room to run. So these are the best values in physical precious metals right now. If you're in the market, there's nothing better than an American 1-ounce gold eagle, especially for US taxpayers. These traded a couple percentage points over their intrinsic gold value. They're the most popular item in the United States, most widely traded, one of the most competitively priced and liquid items. We also like the Canadian gold maple leaf, but we do about 95% of our volume in American 1-ounce gold eagles for tax reasons that we can explain to you on a one-by-one basis. In silver, we like 1-ounce silver eagles for the same reason. Home court advantage. They've been a little pricier than comparable, the Canadian Maple Leaf in premium. We had some real supply shortages due to extreme demand in the spring and into the summer. So premiums on Silver Eagles jumped quite a bit. So we rolled into Canadian 1 ounce silver maple leafs. That says gold and that should really say silver. Sorry about that. I missed that in my proofing. So these are the most popular gold and silver items. They'll track gold and silver as they go up and down. So there's really nothing complicated about them. Just follow the gold price, follow the silver price, and you can follow these bullion items. We also do a fair amount of volume in pre-1933 US gold coins. And there's some real opportunities right now for the contrarian investor. We've seen the rise in gold price drive the price of the more common US pre-1933 gold coins that are tied more directly to their gold price up higher first. It's a bottom-up driven market. So the higher quality coins that naturally have a higher price point and a higher premium over intrinsic content have been lagging in this cycle so far. It's the same thing that happened in 2009 and 10, but when they played catch up like silver just recently did, they played catch up hard. We particularly like the $10 Liberty and the $10 Indian, especially in gem quality MS65 condition and 1 grade lower in near gem MS64 condition today. Here's why. This is a $20 St. Gaudens in Mint State 65, means gem quality. It's one of the most popular US gold coins of all ever, period. You can see right now they're trading for about $2,500 a coin. If you look on our website, we have interactive charts on these coins that show price, premium, and intrinsic gold content value. Let's look at the chart. You can see back in 2010, these coins hit about $2,600 a coin. Today, they're right back up to their previous all-time high. They've come down a little bit lately on this market correction, but this coin is already trading at or a little over its previous market high in late 2009, early 2010. So it'll still go up, but it's already made a big move. What hasn't made a big move already? Well, the $10 Liberty in MS65. This is a real sleeper right now. Let's look at the chart. This coin has a previous market high of just $7,750. It's trading for about $2,600 today. It can go up 65% from here just to get back to its previous high. Or I'm sorry, it's 2 times, 200%. It's about 2,600. It can go back to 7,600 just to get to its all-time high. It's got $5,000 of upside basis today's market price and its previous market high. It's got a lot of room to run. Even if it doesn't get back to $8,000, this is the kind of coin that could go to $4,000 or $5,000 pretty easily from 2,600 today. It's really scarce and it's really overlooked. It's a sleeper right now. We also like the $10 Indian in MS65 for the same reason. It's a bit more popular because of its very cool Indian head design. Trading today for about $3,100. It has a previous market high of $8,000 and then about $7,750. So this coin has about 175% upside potential from here. It's another superb buy in the current market for a contrarian investor. These coins are really scarce. They were used as workhorse coins of commerce. And there's not a lot of them to go around, which is why demand, when it kicks in, can really turbocharge the market. And we can get a run like we saw of 4,000 to 8,000 over a couple-year period. We think this coin has the same kind of potential. So we like the $10 Liberty and the $10 Indian in MS65 condition for about 75% or 80% less. You can get these coins in one lower grade, MS64, with the same kind of profit potential. So that's our presentation. Thank you very much. Once again, Dana Samuelson, President of American Gold Exchange. We're hoping you're having a great conference, and we wish we could be there in person with you next year. Thank you.